Good afternoon, Lori.
Good afternoon, Bill. How are you?
I'm doing well.
I'm going to thank everybody for joining us. I think we have a very relevant and rapidly evolving topic to share today. But before we get started, we ask that you please note our required disclaimers. This makes our regulatory and legal partners happy. And then address a couple of housekeeping items. We'd ask that you please submit questions at any time during the presentation by utilizing the Ask Question function at the lower right corner of your Zoom screen. We'll answer questions both during and at the conclusion of the presentation, and we really want your questions and are interested in hearing from you, so please send them in. Additionally, we'd appreciate it if you would complete the exit survey at the conclusion of our session. This helps us improve and develop content for future sessions. I will skip here to introductions. I'm Lori Taylor. I'm an advisor with Capital Wealth Advisors. I have an extensive background in financial services and have practiced in the wealth management space for the last 25 years. I lean in to listen, and I enjoy helping clients discover what matters most to them. Joining me is founder, president, and CEO of Capital Wealth Advisors, Bill Bynum. Bill has an extensive background in working with wealthy families and has developed unique insights into how families succeed in developing and continuing legacies. Bill leads our firm, Capital Wealth Advisors, a large independent investment advisory and wealth management firm. We have over 40 professionals. Our scope of services include planning, risk management, investment research, investment management, and family office services. We're headquartered in Naples, Florida. We have offices in multiple Florida and North Carolina locations. With that, I'll turn it over to our featured speaker, Bill Bynum.
Thanks, Lori. Thank you for taking the time today. The topics we're going to cover today, I think, are extremely topical. If you've not been living under a rock and watching the news lately, you've seen a lot of discussion around the debate that Congress is having around these two spending bills, the bipartisan infrastructure bill, which is a little over $1 trillion, and then the proposed bill that is for a number of social programs and infrastructure opportunities, which is about a $3.5 trillion bill that is currently in the process of reconciliation in the House, which is a method by which the Democrats have the ability to vote it through without any Republican participation. So it's been top of mind for us because a number of the tax legislative changes that are included in these bills have a dramatic effect on our client base and people that we work with around the country. So today we're going to talk about where we are with current law. What's the law as it stands today? And really, where are we going? What's the proposed law that's on the table? And then talk a little bit about the debate that's going on in Congress that'll hopefully give us some insight on where we think this is going to settle out from not only a spending perspective, but from a tax legislative perspective. From there, we're going to talk about the potential impacts that these fundamental changes in our tax law can have on estates and other asset classes for our families, including their IRAs and some other specific topics. And then we'll shift to sort of how do we deal with it? What do we do going forward? What are our opportunities in this change that's before us? And how do we protect ourselves as we move forward in this new regime of a likely change in substantial tax laws that haven't been changed in this manner in about 4 or 5 years. Someone on the media coined this as the war on the wealthy. That's what we named the presentation, and it really feels that way. There's been a number of discussions in the public media, also from members of Congress, where they are demonizing people that have had success and wealth and using that as a way to justify enhancing taxation on Americans that have either high incomes or have developed substantial net worths. So when you think about it, the discussions that the wealthy can avoid taxes by scheming the IRS, that the 400 richest families pay a lower tax bracket than their employees. All of these sort of media punchlines and rhetoric continue to be pushed by the Democratic Party and the mainstream media to really make us think that the people that have wealth in America aren't paying taxes. I'm a data-driven person, as Lori is as well. So we don't just take the media for their word. We look to the truth of the matter. And the truth of the matter is that there's a large percentage of Americans that do not pay any taxation. And these are not necessarily the wealthy Americans. These are just in general a large part of our population. So this chart that you see here, the dark shows at a certain levels. We're showing an income level here on the left-hand side, starting at less than 10,000 to more than $1 million. And the bottom line is a cumulative value of all. Black means this segment doesn't pay any tax. Blue means that's the percentage that pays tax. And what's interesting to note, despite what I just showed you from the media, 43% of all Americans pay no tax. So the burden, as you can imagine, has been on wealthier Americans to pay the bulk of the taxes in America. And if you look here in this bottom fourth of this chart, this is really where the taxes are being paid from perspective. So don't always take the media's word for it when we're talking about who's paying the taxes and who's bearing the brunt of the planning that is happening in Congress today. I think there are two sort of sides to tax planning in today's social and political environment. The first is really what they refer to as the pay-fors. The pay-fors are tax increases and legislative changes to drive more income to fund or pay for, quote unquote, some type of spending initiative that Congress is putting forward. And certainly that is a big part of what is being proposed today. Secondly, there's the social aspect of this unfairness discussion between wealthy and non-wealthy, high-income earners, low-income earners. So there's a talk that regardless of how much the bill will cost, these taxes are necessary from a social perspective to redistribute the wealth in America. And I'm not taking a political side in that, that's just a discussion that's happening today. So don't always think that taxes are going to be tied to some spending initiative. We may have a situation where taxes are raised simply because they want to change the socioeconomic diversity of our country. So we have current tax laws that are in place. They've been in place since 2017. And we have proposed taxes. So the taxes that are actually proposed from a perspective of what we're going to talk about today, I'm going to talk about the current and the proposed, which is President Biden's administration's written proposal of his goals of where he wants to see the tax legislation. And then we'll talk about where it is today in the middle. And I say in the middle, it's really a debate within the Democratic Party of how far that pendulum will swing. So we'll talk through that as we go forward. Under the current tax laws that were enacted during the Trump administration, the current income tax rate is the highest of 37%, capital gains tax maximum 23.8, corporate tax 21, small business tax 29.6, and estate tax 40. And when we think about that, when we talk about estate taxes are at 40% from a tax rate, but under current rules, there's something called the unified credit, which is the amount of money equivalent that you can transfer tax-free at your passing. So today, every individual American has the ability to leave $11.7 million of assets during their lifetime or at their death without incurring that 40% tax. When I look at the bookend of the other side of this tax world, I look at what was proposed or has been proposed by the Biden administration, which is a dramatic shift from where we are today. So it wants to reenact the pre-2017, 2018 tax reductions, taking the income tax rate back to 39.6, adding a surtax on that for the Affordable Care Act would come back, which is another 3.6%. Taking maximum capital gains taxes to 43.4% for anybody with a gain or income over $1 million cumulatively, taking the corporate tax to 28%, and small business tax back to the ordinary income tax rate. From an estate planning perspective, the administration has proposed taking that $11.7 million unified credit and reducing that to $3.5 million. The law as it currently stands today will revert back to a $5 million credit at the end of 2025. They want to not only advance that reduction, but also reduce it further. And then also increase the rate gradually and scale that from 45 up to 70 for the largest estates. The president has also proposed uncapping the Social Security cost and tax. So right now you pay the 12.4% up to a certain income, and he wants to uncap that for income earners of 400,000 or more, which would be substantial for high income earning Americans. One of the good things in the proposal, he wants to reinstate the itemized deduction ability for what many call the SALT tax, which is for the state, local, and property tax credit that you would get, or deductions you would get against your federal taxes. One of the other things that President Biden has pushed pretty heavily is the elimination of the step up in basis. Currently, under the law, if you pass away and you have embedded gain in your assets and you pass away, the cost basis steps up or resets at your death to the value of that asset at the date of death, enabling families to pass assets without incurring a capital gains tax. So on the proposal from the administration, that is something that they in their wish list would like to see change. Now, some of these changes may come in the legislation that's before us that we're about to talk about, but certainly based on that social and political view of taxation on the wealthy, this bill is likely not to be the last tax increase that we see. Again, looking at the goals of the president, we may get partway there with these bills, but we're likely to see for the rest of the term additional changes to the tax law based on what we're hearing out of Washington. So just graphically, you look and you can see the difference between the Biden proposal and the Trump tax rates. Obviously, it's increasing taxes quite a bit on many Americans. And again, if you think about it, 43% of Americans don't pay tax. So this is really focused on those that do. When we think about where do we stand in the world, how's the US taxed from a capital gains perspective, as an example, I love this data. Currently, you can see we're kind of middle of the pack, kind of right between Sweden and Israel at 29.2 is a maximum rate, including some state taxes. And this would put us up literally at the most highly taxed for gains in the world. So again, does that drive investment in America and American investments? I would argue that it doesn't, but just a point of data, this is where we would stand if this goes through. So other things that are proposed on the chopping block, grantor trusts. So grantor trusts are irrevocable trusts that you can create to gift assets into, to move assets outside of your estate. A grantor trust is a type of irrevocable trust that enables you to split the income taxation from the estate taxation. Meaning, if I made a gift of $1 million to a trust for the benefit of my daughter, and that trust had income or gains inside that trust, that taxation from an income perspective could flow back out to me as the grantor to pay those taxes. And then the corpus of the trust would be tax-free to my daughter at my passing. They want to take away that grantor trust status. In many cases, that wouldn't affect individuals from a tax perspective. We could work around that. The problem with it is almost every life insurance trust that's held in an irrevocable trust for the purpose of estate tax planning is in a grantor trust based on my 20 some odd years of doing this. And the way that the proposal is laid out, we would have old grantor trusts would be grandfathered in. New grantor trusts after they're grandfathered in, if you make a new contribution after January 1, it could pull that entire value back into your estate. So if this becomes law in the tax code, we really want to make sure that we're looking at existing structures that families have to make sure that we're not inadvertently bringing assets back into their estates. They also want to take away GRATs, which is another type of trust planning that's in the statute. GRATs have been a way that families have been able to give away assets over time while retaining income. Excuse me. And they've been on the radar of the last several administrations to change. We can assume those are going to go away. And then valuation discounts. Currently, if you give away an asset, hypothetically, if I own an LLC that has buildings in it, commercial real estate in it, and I give away non-voting shares of that to my children or a trust for their benefit, I have the ability to reduce the value of that for gift tax returns, called a valuation discount. That's actually going to go away under the current proposal, which means fair market value would be the value of the gift, regardless of control or marketability of the underlying non-voting shares. So just things to consider. If you have planning that you're contemplating, if you have existing trusts that are in place, especially those that require annual funding for insurance policies, very important to talk to your estate planning lawyer, your financial advisor. If you want to talk to us, we're happy to help with that. But there's definitely a need to make sure that we're looking at those under this new lens with the law change. So where do we stand now? The Democrats, again, I gave you two bookends. I gave you current and I gave you what was proposed. Interestingly enough, the argument hasn't been among parties, it's been within the Democratic Party. So on the left-hand side, you see Ilhan Omar, Bernie Sanders, Alexandria Ocasio-Cortez. They are three members of what we would call the squad. They're the progressive wing of the Democratic Party. They are pushing for the president's agenda, really wanting to bring the tax against the wealthy as high as possible, if not higher. And on the right-hand side, you have two more moderate, or someone described as conservative Democrats, in Kristen Sinema from Arizona and Joe Manchin from West Virginia. Because we have such a tight breakdown between Republicans and Democrats in the Congress, the Democrats cannot use reconciliation unless they have the two votes of the people on the right side of your screen. So Senator Sinema and also Senator Manchin have basically said that they want a reduction in the size from $3.5 trillion to a maximum of $1.5 trillion. That debate continues on today. So it's likely that some of the tax proposals that President Biden had in the original structure may get reduced or changed over time. We'll talk about a couple of those as we go forward, but we really need to keep an eye on how this plays out. Even though they won't need, quote unquote, the pay-fors if the bill is smaller, many in the progressive wing of the Democratic Party said they still want to keep the same tax legislation because they feel it's a social need from a perspective of redistributing that wealth. So we need to keep an eye on that. But right now, it's very interesting watching the debate. My guess is that they're trying to get something negotiated before the end of the year. It's kind of day by day, so you want to keep an eye on that. Luckily for us, there's lots in the news every day about this, and we'll be able to follow pretty closely. One of the things that the Democrats and Republicans have been able to agree on over the past several years is some fundamental changes to IRA and retirement planning. So in 2018, they passed something called the Secure Act. It took effect in 2019, and it really was focused on trying to help Americans save more for retirement and change some aspects to how retirement plans operated. So just a few highlights. This really is important for those of you that have IRAs that are approaching the age of required minimum distribution, which is when you have to be forced to take a payment out. The Secure Act moved the date of distributions now begins at age 72 versus age 70 and a half. So allow people to defer that income for a couple more years. From a retirement plan, allowed long-time part-time workers to participate in 401k plans. It provided more income generative options inside retirement plans. It allowed parents to withdraw monies for adoption and also for the payoff of student loans out of 529 plans. All of those things are wonderful. The one thing that they did in this act that was not so wonderful was they took away the ability to have what they call a stretch IRA. Stretch IRA was the ability for you to take your IRA, leave it to your heirs, and they could take that required distribution out over their life expectancy. So maybe in some cases, a 40-year stream. With the change in the Secure Act, they shortened that to 10 years if you're leaving the IRA to an individual, to a human, child, or grandchild, and they've shortened it to 5 years of distribution if you leave it to a trust. So if you have IRAs, we want to do a review of how you're leaving those, who you're leaving those to, what the beneficiary arrangements are. And certainly if you're leaving them to a trust, likely the language needs to be adjusted in a trust to take advantage of a new law. So that's an important thing to keep in mind. And I'll recap this as we finish up today. So surprisingly, again, Congress has found common ground in Secure Act 2.0, likely to change again this year, again, adding some additional tax benefits for savings. The biggest piece to keep an eye out for, it's been proposed to take that minimum distribution age from 72 to 75, also allowing contributions to IRAs for employees that are working longer up to age 75. So there will be a slight adjustment likely this year. It looks like they have the votes and it's going to be voted on here in the coming weeks. So likely to have Secure Act 2.0. So as we think about all these things, what's the potential on our estates? What do we need to be worried about when we're looking at all of these prospective changes and how they affect us and our families and our heirs? So initially, if you look at the Biden plan, we had three major factors to consider. We had the unified credit reduction, we had the elimination of the step up in basis, and we had an increase in capital gains tax. At least for now, in the current legislation, they've taken the step up in basis change off the table. So we really need to focus on two things. We need to focus on where we're going to be with the unified credit, and we need to understand where we are from a capital gains tax perspective for our planning and our assets. So luckily for now, we can avoid one tragedy in the step up in basis going away. But as I said earlier, it's likely to come back up in the next session of Congress in 2022. So we have a potential double dip. So with a lower unified credit, higher tax rates, those two things combined can really have an impact from an estate perspective. They can really be confiscatory from perspective of the values that your families are receiving when you're leaving them assets. As we think about the U.S. federal estate tax, historically, the estate tax has been had a fairly low tax-free transfer, and in history, a much higher tax rate than we have today. If you look at this chart here, you'll note going back to 1979, the highest tax rate was over 60%. That did trend down over time. And when we look at it from a perspective of the credit, you'll note that the credit really started to rise in the early 2000 era. Initially, that was a more of an indexing of value. So back in those days, the unified credit was 600,000, and they indexed that up over time. We had a major change in 2010 where we had no estate tax, and then it reverted to this $5 million level with some indexing. And then in 2017 was voted up to 11 million and has grown to 11.7 under those indexing provisions as well. So you can see that this combination of tax-free credit and tax rate are really anomalies as we look at it from a historical perspective. So the likelihood that we end up with a lower estate tax credit as well as a higher rate is in my view pretty likely. Also to understand, when the government created this this increase in 2017, there's something called the Byrd Rule created by Robert Byrd, the former senator from West Virginia, during the balanced budget days, that basically said if you projected tax legislation past 10 years, it had to be revoted on at the end of 10 years, or it reverted back or sunsets back to the original law. So this $5 million level that we have right here, if nothing is done by the Congress, in the end of 2025, we will revert back to this level right here. So that is in play as we see it today. So how do we protect the value of our estates? How do we pass more assets to our children and our grandchildren? What are the things that are most important to us? The first thing in any plan is we have to really think about the foundational documents. Many times people will come in to see us and talk about advanced estate planning, but they haven't revisited their basic documents, their basic disposition of assets that they're passing. And many times they come to us with foundational documents that are very old, and they really don't meet the current status of the family goals. So it's a very good idea to review on a regular basis every few years your revocable trusts, your wills. When we think about a revocable living trust, very important to eliminate the act and the cost of probate. So a revocable living trust allows us to pass assets outside of probate. It takes the place of a traditional will. And when we have a revocable living trust, the will becomes a cleanup document called a pour over will. And it basically says anything that I've left out of my trust during my lifetime, pour it in. The other foundational documents would be your financial powers of attorney, your medical powers of attorney. Some states like Florida, where we're headquartered, they're more strict because we have so many people in and out seasonally that you don't want these documents to be more than 3 to 5 years old. You want to refresh those. HIPAA authorizations, allowing your family to gather medical records if you're incapacitated, making medical decisions, the medical power, very important. And then a living will, some would also call advanced directives, important to have as your foundational documents when we're looking at our planning. I think another way to protect our estates is we need to think about today gifting. As I said, the $11.7 million credit is proposed to be reduced at a maximum to $3.5 million and a minimum to between $5 and $6 million. So we don't want to lose what's in front of us today as an opportunity to gift assets out of our estate. We can make annual exclusion gifts, which are gifts that can happen every year per donor per person, $15,000 a year. So a couple can give $30,000 to each child, every relative. In 529 planning, you can advance those over 5 years. So it's a great way to reduce the value of your estate over time. And then we have the unified credit, the 11.7. And I think it's very important for us to look at this as a year-end opportunity. And I would tell you, based on the volume that we're seeing, not only in our practice, but in other colleagues in the legal and accounting side, we want to get this started today, because if you wait till the end of the year, it's likely that you won't be able to get it accomplished before that January 1 deadline or 12/31 deadline when the law will take effect. So currently the unified credit's 11.7, 23.4 million per family. Anything above that is taxed at 40%. In the reconciliation discussion right now, they've negotiated from 3.5, which was Biden's proposal, back up to 6 million, which is the index value of the old law. So 12 million per couple, and it will have effect January 1, 2022. So if you haven't used the 11.7 before January 1, you have lost it. So it's use it or lose it. Like anything else, when we're faced with change and we're faced with legislative adjustments, tax law changes, innovation appears to help solve our problems. So one of the ideas that we had back in 2012 when we were facing this the last time was, how do we give assets away, but at the same time allow families to keep some manner of control with them? So there's something developed at that time called a spousal lifetime access trust. And we're going to talk about that, how they work fundamentally. From that, we also learned that there were some things in there that were more risk-oriented to families if they were younger. And so there was an additional nuance created called a SPAT, which allows a provision to be put in the trust that I'll talk through, that I think is ingenious, created by a lawyer here in Florida, that kind of allows us to give an asset away but keep a string on it for the purposes of safety. So spousal lifetime gifting trusts are really simple. It's the ability for each spouse to create a trust for the other spouse and utilize that $11.7 million to fund that vehicle. Caveat, though, is you cannot have trusts that are identical. If you have trusts between you and your spouse that are identical, there's something called the mirror trust doctrine, and the IRS will say that if they're substantially identical, you cannot have them. They get canceled out. So you have to look to an estate planning lawyer that has experience in drafting these. There are very specific differences in the provisions of the trust to allow us to do one for each spouse at the same, within the same time period. You don't want to do them at the same day, the same year, but within a period of time, they can be accomplished, but you make sure that you have a law firm that's experienced in doing this. So in this example, we create two trusts. They're fundamentally different, but accomplish the same goal, which is we have the ability for the husband and wife to fund these for each other. So in the example is the husband creates a trust for the benefit of his wife. He funds that with $11.7 million. His wife is the primary beneficiary, and she is also the trustee. So it is an asset. It's a trust that's outside their estate, but controlled by his wife. And the wife can do the exact opposite, the spouse, and create one for her husband, again with some differences in the provisions of the trust. Those trusts then long term, whatever's in those trusts plus the growth of those trusts will be outside of the taxable estate. But if I stop right here and I look at the structure, I have a trust where my wife is the trustee and the beneficiary. If she needs access to that 11.7, she can go in and get it. And the same with the trust in my box to the right, enabling me to get access to that. Now, things to consider, risks to consider. One, we talked about the mere trust doctrine. Two, if you and your spouse get divorced during the deal, you each own your trusts, so you need to be aware that those assets can be disposed of outside of a divorce. So you've already given them to your spouse or a trust for their benefit. So keeping that in mind. And then at death, the idea is the trusts will pass down to children and grandchildren. And again, the corpus plus the growth of those are outside the estate. The last risk that you have is, God forbid, I would pass away substantially early, and the trust that my wife created for me in this example would go to my daughter. It wouldn't go live on for my wife. So there was a risk in this original back in 2012 when we started doing these. Well, how do we plan for the fact, what happens if I predecease my wife early? Does she have enough other assets to live the manner in which she wants to? And as we talked about that, some lawyers got together, one specifically here in Florida, and basically said, hey, I think there's a way that I can structure the document to say that if, God forbid, Bill dies early, we can have his trust live on until his wife's subsequent death. And we can give a third party something called a special power of appointment that enables them to appoint assets back to Bill's wife if they're needed during the balance of her lifetime. So it gave us a way to put a provision in these to solve that risk. So again, if you're talking to your lawyer about cross gifting, or you want to talk to us, we can lay it out for you. You want to make sure that you have these provisions because it adds another layer of safety and security for surviving spouses. So as I think about planning, I think back to, again, doing this for 25 plus odd years. I think about all the times that clients said things to me that had an impact. And one of my favorite clients, a retired athlete, he keeps a lot of cash in his account. And I asked him, I said, well, why do you keep a lot of cash in your account? And he said, well, nothing spends like cash. And I would tell you, the other organization that believes in that statement is the IRS. They don't want your stuff, they want cash. And you have to have cash in order to pay the taxes that are owed. So many times clients have said, oh, I grew up with nothing. My kids can live on half the estate tax, they'll be fine. That's great. But if you've really taken a look at the liquidity analysis of your estate and your assets to understand whether that makes sense, or whether that really works or not, will they really get half at the end of the day? Well, I subscribe to an information series put out by a company called WealthX. And WealthX over the years has done a refresh of the same study. But in 2018, they surveyed ultra high net worth families in the United States to identify how much liquidity that they had. And these were people specifically over the age of 70. And over the age of 70, the study showed that only 38% of their net worth was liquid. So if you think about that, what's that tax rate we talked about? It's 40% for estate taxes, potentially going up to 55 or higher. And we only have 38% in cash or liquid assets, which means we're going to have to sell some things to pay that tax. And depending on timing, that might be really, really detrimental to you. So I think back to the father of a client of ours and his profile. He was not my client, I represented his children. Very successful entrepreneur. He's in his 70s, was divorced, had 2 kids. His estate was in the hundreds of millions of dollars. And his view was, I made it all from nothing. Let my kids live on half, pay the tax, let them have the balance. There was a problem though. He passed away unexpectedly in December of 2007, which was right in the beginning of the teeth of the financial crisis. He had a lot of, there were no assets classes that didn't have declining values. And even though you could revalue from an estate tax perspective later, it didn't matter. Asset prices were falling like a stone. And the tax was due in 9 months. He actually had 2 taxes due. He had one due in the US and one due in France, both due 9 months from the day of death. Think about that. That puts you right in 2008. And we remember how the financial crisis was hanging on. He had 80% of his net worth in illiquid commercial and residential real estate and art. So again, only 20% liquid. And part of that liquid asset that he had was tied up in pledged assets, if you will, from a lending perspective. So, and much of the real estate was in New York and Miami, New York City and Miami. And if you can think about that, it wasn't that you couldn't get the price you wanted, you couldn't get anybody to bid on it. So the kids were really in a big panic with regard to how they're going to pay that estate tax. In addition to that, he had, I think, 8 homes. He had a number of household employees, and there was a lot of carry costs to his estate. So that was also chewing through liquidity as they were settling the estate. So again, really had an impact for the kids. They had to, unfortunately, put leverage on the artwork at a very high cost. They had to sell assets at depressed prices. And at the end of the day, they lost over 90% of the value of the estate because of the reduction in value and the creation of that liquidity. So very, very, very important to look at liquidity from an estate perspective to make sure that you have enough liquidity to fund that tax. So we have designed a piece of software that enables us to do that analysis. Happy to help you take a look at that. Should be something that you look at. As I go back to that WealthX study, the one that they had done one several years earlier on people 80 years and older, and the average I think was 27% was liquid. So again, as you get older, you spend down your liquid assets, your illiquid assets grow. Really, really an issue. In his case, it could have been much worse. Imagine if the capital gains tax was higher. Imagine if the exemption was lower. So again, compounding that issue. So what do we have to look for when we're doing these analysis? We look for concentration of illiquid assets, real estate, operating companies that have expenses, carry costs for the estate. Do you own private equity? Salt in the wound for this family was 6 months into the estate settlement. They had a capital call on a private equity investment that their father had made. They had hedge funds without death redemption options. And again, in 2008, a lot of those hedge funds were gated. We also look for liquid, but not really liquid. Retirement plan assets, IRAs, those are going to be subjected to ordinary income tax if you liquidate them. So again, not the best asset to fund, as well as tax deferred assets, deferred compensation, deferred annuities. You also need to look in the estate plan to make sure if you have direct cash bequests that come off the top of the estate, very important to make sure that's worded properly. You can Google this. James Gandolfini, the famous actor from the TV series The Sopranos, when he passed away, he had left his ex-wife and children a large sum of his estate in liquid assets and cash off the top, but his estate plan was written incorrectly. And what happened was his current wife ended up with a much smaller estate, but 100% of the tax liability. So you can really make a mistake with how that's drafted. So if you have direct bequests, make sure that you're thinking through those. If you have a blended family or a second marriage, make sure that we're understanding how the assets are going to flow. If we have, assets with embedded capital gains, we need to keep an eye on whether or not that step up in basis is going to go away. So very, very important topics to think about. And again, it's something that you unfortunately can't do just once. You have to look at this on a regular basis as our asset mix changes. It also, in my opinion, changes sort of the risk tolerance and the view of what you're going to invest in as you age, because you want to make sure more liquid assets are favorable compared to less liquid over time. So as we think about today, we have major shift in tax legislation upon us. It's almost changing daily. We likely will see a conclusion of this in the coming weeks before the end of the year. So very important to review your trusts, especially your grantor trust, create a plan. Understand if you have ongoing gifting obligation, these trusts, how are you going to restructure it and fund it under the new law? Tax capital gains are going up. We don't know the total level yet, but maybe consider tax loss harvesting and gains harvesting, both. Can we sell some assets, harvest some gains, pay a lower rate today than we will in the future? If you have unified credit available and you have the ability to use it, consider gifting unified credit assets. SLATs and SPATs are a great way to do that. There are other ways that we can help you show as well, depending on the makeup of your estate. Maximize your annual exclusion gifting. Every dollar you get out of your estate, not only that dollar plus the growth on that dollar saves a 40% tax. And then with Secure Act, you want to make sure that we review our IRA planning. How are we putting our beneficiaries through? What does it look like from a perspective of if we're leaving it to individuals or trust? Make sure you're reviewing that over the coming years as you approach that time period. And we're certainly available to help if you have questions and you'd like for us to set a time. Here's Lori's information. Lori heads our office in Raleigh, and actually in Cary, North Carolina. I say Raleigh because some people don't know where Cary is. Beautiful spot in the world, and we'd love to have an opportunity to help. So Lori, I'll open it up if you have some questions.
We have some questions. So the first question is, when will all this be decided? How do I know what to do? When will all this be
Yeah,
decided?
so I don't have a crystal ball. I think it's likely to be decided before the end of the year. It's kind of day by day. So we're recommending to our clients, don't focus on whether it has passed yet or not. Assume it's going to and begin the planning process now. Because otherwise, if you wait too long, you're not going to get it done in time. The debates are going on daily. Again, these are within the Democratic Party. And it's two against the world, but those two people have the power, and Kristen Sinema and Joe Manchin. So likely to happen in the coming weeks, but start your planning today.
Okay, we have another question about the capital gains rate and relating to when an increase would actually take place.
Yeah. So
we thought it took place already.
Two schools of thought. It hasn't passed yet. So, and again, legislation will be changed up until the moment that they submit it for vote. Not the estate tax portion, but the capital gains portion. There are two schools of thought. One was that they thought they were originally going to pass this very quickly. And so they had originally put a date of, I think, September 18th as an effective date for the capital gains rates. I don't know if that will hold true if they pass it December 1st. So we're just going to have to wait and see. They're likely to either do it on the date of the law going into effect or the end of the year.
So Bill, if clients are still thinking about trying to potentially recognize capital gains, at the current lower rate, believing that it does go higher, should they ignore that September date? And
well, I mean, I'd still give it a try. I mean, right now the rate that their initial rate they're talking is lower than the 43 or 44%. They're talking about raising it by 5% for this first round. So the reality of it is we don't know what they're going to do. So you can give it a try, but know that it might not work. We really have no way to control that. I find it unlikely that they would be able to retroactivate it back to September, since it's taken so much longer than they thought. They originally thought that this was going to pass in a day. And that's why I think they'd written it that way. So we'll see as it plays out. But, again, if you have something and you're okay in a worst case scenario that you're going to pay 5% more, it's likely capital gains are going to go up again next year. So not a bad idea to take those gains.
So another question that we have is about what about single people? You talked a lot about families or couples, but is there anything that single people should think about specifically?
Yeah, I think the same thing. I think depending on your situation, that unified credit is still 11.7 million. The planning is somewhat different for single individuals, so we'd want to talk through the various trust and gifting options. But absolutely, if your estate is subjected to an estate tax, you have the over and above the 11.7 credit, you really need to consider using that today. And there's a variety of strategies we can walk you through with those.
Another question that we have is, you talked about different trusts that can be created, but does that mean I'm going to get audited by the IRS?
No, not necessarily. I mean, audits are obviously always possible in what you do. The creation of a trust would not necessarily trigger an audit. Audits would be triggered based on a tax return. So if you make a substantial gift into a trust, you have to report that on a gift tax return and Form 709. And that is very important because you want to make sure that you're acting above board and reporting gifts that you're making. They certainly can always be looked at, but I would say with the lack of valuation discounts, if you're still doing those this year, if you're aggressive, that could trigger an audit. Or if you didn't correctly report the gift, that sort of thing. The gift tax audits are less frequent than income tax audits. But again, the creation of a trust doesn't necessarily trigger any type of audit.
Thank you. please, if you have other questions, please reach out. We're happy to answer them.
Yeah, and thank you for participating today. We wanted to keep you within the time limit. Hopefully, I think I went over a little bit, so hopefully not too long. And again, if you have an opportunity and you'd like to chat or have a question, contact information, phone numbers on the board, we'd happy to do that for you. If you have additional questions, feel free to email those in, and we'll get to them right away for you. And Lori, thank you for hosting me
Thank you.
today, and I hope everyone has a wonderful week.
Thank you, Bill.